Introduction to Creative Real Estate Financing. Creative financing in real estate involves non-traditional methods of funding property purchases, often used when conventional loans are unavailable or undesirable. These techniques allow buyers and sellers to structure deals that benefit both parties, overcoming common market challenges like high interest rates or strict lending criteria. Understanding these methods is crucial for investors seeking to differentiate themselves and find opportunities in competitive or niche markets. It requires a deep understanding of legal frameworks, negotiation skills, and a willingness to think outside the box. This approach can unlock potential deals that might otherwise be impossible, creating win-win scenarios for all involved stakeholders. It empowers individuals to acquire properties with less upfront capital or to sell properties more quickly. Ultimately, creative financing is about flexibility and problem-solving in real estate transactions. The primary goal of creative financing is to facilitate property transactions that might not fit the mold of standard bank loans. This can include situations where the buyer has less than perfect credit, the property itself is unconventional, or the seller needs to offload the asset quickly. By employing these innovative strategies, participants can navigate complex market dynamics and achieve their real estate objectives. It opens doors to a broader range of investment opportunities, from single-family homes to commercial properties. Mastering these techniques provides a significant competitive advantage in the real estate industry, enabling more agile and adaptable investment practices. This course will explore various proven methods and their practical applications. Why creative financing is essential. Traditional financing methods, while common, often present significant hurdles for both buyers and sellers in the real estate market. Strict lending criteria, high down payment requirements, and lengthy approval processes can deter potential buyers, especially those with non-traditional income streams or limited capital. Sellers, on the other hand, might face challenges finding qualified buyers quickly, particularly for unique properties or in slow markets. These limitations can lead to missed opportunities and prolonged sales cycles, impacting profitability and efficiency. Creative financing techniques emerge as powerful tools to circumvent these obstacles, offering flexibility and speed. They provide alternative pathways to property ownership and disposition, benefiting a wider range of market participants. Understanding these limitations highlights the necessity of exploring diverse funding options. The current economic landscape, characterized by fluctuating interest rates and evolving credit markets, further underscores the importance of creative financing. Investors and homeowners alike need adaptable strategies to navigate these changes effectively. Creative financing allows for tailored solutions that can address specific needs, such as a seller needing a quick sale or a buyer lacking a substantial down payment. It fosters a more dynamic and accessible real estate market, encouraging transactions that might otherwise stall. By embracing these innovative approaches, individuals can maintain momentum in their real estate endeavors, regardless of external economic pressures. This adaptability is a cornerstone of successful long-term real estate investment. Understanding seller financing basics. Seller financing, also known as owner financing, occurs when the seller of a property acts as the lender to the buyer. Instead of the buyer obtaining a loan from a traditional bank, they make payments directly to the seller according to an agreed-upon schedule. This arrangement can be particularly beneficial for buyers who may not qualify for conventional mortgages due to credit issues or insufficient down payment funds. For sellers, it can attract a wider pool of buyers, potentially leading to a quicker sale and often a higher sale price. It also allows sellers to earn interest on the loan, providing a steady income stream over time. This method bypasses many of the stringent requirements and lengthy processes associated with institutional lenders. It's a direct agreement between two parties, offering significant flexibility. The terms of a seller finance deal are highly negotiable, allowing both parties to customize the agreement to their specific needs. Key elements typically include the purchase price, interest rate, down payment amount, payment schedule, and the loan term. Often, a balloon payment is structured at the end of the term, requiring the buyer to pay off the remaining balance or refinance through a traditional lender. It is crucial for both parties to have a clear, legally binding contract outlining all terms and conditions to protect their interests. Seeking legal counsel is highly recommended to ensure compliance and mitigate potential disputes. This flexibility in terms is a hallmark of creative financing. Mechanics of seller financing implementation. Implementing seller financing involves several critical steps to ensure a smooth and legally sound transaction. First, the buyer and seller must agree on the fundamental terms, including the purchase price, down payment, interest rate, and payment schedule. Once these basic terms are established, a promissory note is drafted, outlining the buyer's promise to pay the seller. Concurrently, a deed of trust or mortgage is prepared, which gives the seller a lien on the property, protecting their interest in case of default. These documents are then signed and typically recorded with the county recorder's office to make the lien public. This formalizes the agreement and provides legal recourse if issues arise. Throughout the loan term, the buyer makes regular payments directly to the seller. It is common for a servicing company to handle these payments, providing an impartial third party to manage the collection and distribution of funds, as well as maintaining accurate records. This can simplify the process for both parties and ensure professional handling of the financial aspects. At the end of the loan term, if a balloon payment is due, the buyer must either pay the remaining balance in full or secure new financing to do so. Upon full repayment, the seller releases the lien, and the property is entirely owned by the buyer. Clear communication and documentation are paramount at every stage. Lease options, fundamental concepts. A lease option, also known as a rent-to-own agreement, provides a tenant with the option to purchase the property they are currently leasing at a predetermined price within a specific time frame. This arrangement is particularly attractive to individuals who aspire to home ownership but may not currently qualify for a traditional mortgage due to credit issues or insufficient savings for a down payment. The tenant typically pays an upfront, non-refundable option fee, which often gets credited towards the purchase price if they decide to exercise the option. This fee secures their right to buy the property, preventing the seller from selling to someone else during the option period. It offers a pathway to homeownership that is more flexible than conventional methods. During the lease period, the tenant makes regular rent payments, and a portion of each payment might also be credited towards the purchase price, further building their equity. This structure allows the tenant buyer to improve their financial standing, save for a down payment, and repair their credit score while living in the home they intend to buy. For sellers, lease options can attract a wider pool of potential buyers, generate immediate income through rent and the option fee, and potentially achieve a higher sale price. It also keeps the property occupied, reducing vacancy risks and maintenance concerns. Clear terms regarding the option period, purchase price, and credit for payments are essential for a successful agreement. Lease options, advanced strategies. Beyond the basic structure, advanced lease option strategies involve creative structuring to maximize benefits for both parties. One such strategy is the sandwich lease option, where an investor acts as an intermediary. The investor leases a property from an owner with an option to buy, and then simultaneously leases it to a tenant buyer with an option to buy at a higher price. The investor profits from the difference in the option fees, the monthly rent spread, and the eventual purchase price difference. This strategy allows investors to control properties with minimal capital outlay, leveraging the property without owning it outright. It requires careful management and understanding of market values. Another advanced technique involves structuring lease options with specific clauses to address potential market changes or property improvements. For example, the agreement might include provisions for adjusting the purchase price based on future appraisals, or for crediting the tenant buyer for significant renovations they undertake. These clauses provide additional flexibility and incentives, making the deal more attractive. It is also common to incorporate performance-based incentives for the tenant buyer, such as a larger portion of rent credited towards the purchase if they consistently make on-time payments. These sophisticated approaches require detailed legal documentation and a clear understanding of all parties' objectives to ensure success and avoid disputes. Subject to deals. An overview. A subject to real estate deal occurs when a buyer takes over a seller's existing mortgage without formally assuming the loan. The title to the property transfers to the buyer, but the original mortgage remains in the seller's name. The buyer then makes the mortgage payments directly to the lender. This strategy is particularly useful for sellers who need to sell quickly, avoid foreclosure, or preserve their credit, as the mortgage payments continue to be made on time. For buyers, it offers a way to acquire property with little to no down payment, and often at a lower interest rate than new financing, as they are taking over an existing loan. It bypasses the need for new loan qualification, speeding up the transaction. While highly advantageous, subject to deals carry inherent risks for both parties. For the seller, the primary risk is that they remain legally responsible for the mortgage. If the buyer defaults on payments, the seller's credit will be negatively impacted, and they could face foreclosure. For the buyer, the due on sale clause in most mortgages is a significant consideration. This clause allows the lender to demand full repayment of the loan if the property's ownership changes. Although lenders rarely enforce this if payments are current, it remains a potential risk. Proper legal documentation and a clear understanding of responsibilities are paramount to mitigate these risks. Due diligence is critical for both parties. Subject to implementation and risks. Implementing a subject to deal requires meticulous attention to detail and a thorough understanding of the existing mortgage terms. The first step involves reviewing the seller's current mortgage documents to identify any due on sale clauses and assess the loan's overall health, including payment history and outstanding balance. Once both parties agree, a purchase agreement is drafted, explicitly stating that the property is being purchased subject to the existing mortgage. The deed is then transferred to the buyer, but the mortgage remains in the seller's name. It is crucial to notify the existing lender about the change in ownership, even though they may not formally approve the assumption. This transparency can sometimes prevent issues later on. Mitigating the risks in a subject-to transaction involves several protective measures. For the seller, ensuring the buyer is reliable and has a strong payment history is paramount. A robust, legally drafted agreement should include clauses that protect the seller, such as the right to cure defaults or even repossess the property under specific conditions. For the buyer, understanding the due on sale clause and having a contingency plan in case the lender calls the note due is essential. This might involve having access to alternative financing or a clear exit strategy. Both parties should engage independent legal counsel to review all documents and ensure their interests are adequately protected. Open communication and trust are also vital components of a successful subject-to deal. Wraparound mortgages explained. A wraparound mortgage, also known as a wrap or all-inclusive trust deed, is a form of seller financing where the seller extends a new mortgage to the buyer that wraps around the seller's existing mortgage. The buyer makes payments to the seller, who then uses a portion of those payments to cover their original mortgage obligation. The seller profits from the difference between the interest rate on the new wraparound mortgage and the interest rate on their underlying mortgage. This strategy is particularly appealing when the seller's existing mortgage has a low interest rate, allowing them to offer the buyer a competitive rate while still earning a spread. It simplifies the transaction for the buyer, as they only deal with one lender, the seller. The key advantage for buyers is often a lower down payment and potentially more flexible terms than traditional financing, as well as the convenience of a single payment. For sellers, it provides a steady income stream, the potential for a higher overall return due to the interest rate spread, and the ability to sell a property quickly without paying off the underlying loan. However, Risks exist for both parties. The seller remains liable for the underlying mortgage, similar to a subject to deal, and must ensure timely payments to their original lender. The buyer faces the risk that the seller might default on the underlying loan, potentially jeopardizing their ownership. A well-drafted legal agreement and an escrow service are crucial to manage these risks and ensure proper payment distribution. Hard money lending explained. Hard money loans are a type of short-term asset-backed financing, typically provided by private investors or companies rather than traditional banks. Unlike conventional loans, which focus heavily on the borrower's creditworthiness, hard money lenders primarily base their decisions on the value of the real estate property itself. This makes them an attractive option for investors who need quick access to capital, have less than perfect credit, or are dealing with distressed properties that wouldn't qualify for traditional financing. The approval process is significantly faster, often taking days instead of weeks or months, which is crucial for time-sensitive deals like foreclosures or fix and flips. These loans are designed for speed and flexibility, not long-term holding. Due to the higher risk associated with hard money loans, they typically come with higher interest rates and fees compared to conventional mortgages. The loan terms are usually short, ranging from 6 months to 3 years, and often involve interest-only payments with a balloon payment at the end. Lenders usually offer a lower loan-to-value (LTV) ratio, meaning they will only lend a percentage of the property's value, requiring the borrower to have more equity or a larger down payment. Hard money is best suited for experienced investors who have a clear exit strategy, such as quickly renovating and reselling the property or refinancing into a traditional loan. It is a powerful tool when used strategically for specific short-term investment goals. Private money lending strategies. Private money lending involves borrowing capital from individuals or groups of private investors rather than institutional lenders. These loans are often secured by real estate, similar to hard money, but typically offer more flexible terms and potentially lower interest rates than hard money loans. Private lenders are often more relationship-driven and can be more understanding of unique deal structures or borrower circumstances. This approach is excellent for real estate investors who have built a network of contacts interested in earning passive income through secured investments. It allows for highly customized loan agreements tailored to the specific needs of both the borrower and the lender. The process can be much faster than traditional banking, relying on trust and direct negotiation. Finding private money lenders often involves networking within real estate investment communities, attending industry events, and leveraging personal connections. Investors typically present their deal proposals to potential lenders, highlighting the property's value, the project's profitability, and the security offered. The terms of private money loans are entirely negotiable, encompassing interest rates, loan duration, payment schedules, and collateral. It is crucial to have a well-defined business plan and a clear exit strategy to instill confidence in private lenders. A strong track record and transparent communication are key to attracting and retaining private capital. This method provides a powerful alternative to traditional financing, fostering direct investor-to-investor relationships. Partnerships and joint ventures. Real estate partnerships and joint ventures, JVs, involve 2 or more parties pooling resources, expertise, and capital to acquire, develop, or manage real estate properties. This creative financing technique allows individuals to undertake larger projects than they could manage alone, leveraging collective strengths and mitigating individual risks. Partners can contribute in various ways, such as providing capital, offering construction expertise, managing property operations, or sourcing lucrative deals. It is particularly effective for new investors who can partner with experienced professionals to gain knowledge and access to opportunities. These collaborations open doors to projects requiring substantial investment or specialized skills, fostering mutual growth and shared success. Establishing a clear and comprehensive partnership agreement or joint venture agreement is paramount to the success of these collaborations. This legal document should meticulously outline each party's roles, responsibilities, capital contributions, profit-sharing ratios, decision-making processes, and exit strategies. Transparent communication and a shared vision are critical for maintaining a harmonious and productive working relationship. While partnerships offer significant advantages in terms of shared risk and expanded capabilities, they also require careful management of interpersonal dynamics and potential disagreements. A well-structured agreement anticipates potential conflicts and provides mechanisms for resolution, ensuring the venture remains focused on its objectives. Equity sharing agreements. An equity sharing agreement is a creative financing arrangement where two or more parties co-own a property, typically a primary residence, with one party providing the down payment and/or mortgage payments, and the other party residing in the home. This allows a homeowner, often someone who cannot afford the entire cost, to gain access to a property with assistance. The non-resident owner, known as the investor or money partner, contributes capital in exchange for a share of the property's appreciation and potentially a portion of the tax benefits. This arrangement formalizes the division of ownership, responsibilities, and future profits, making homeownership accessible to a broader demographic. It's a structured way for an investor to participate in real estate without the day-to-day management. Key elements of an equity sharing agreement include defining the ownership percentages, outlining who is responsible for mortgage payments, property taxes, insurance, and maintenance costs, and specifying how appreciation will be calculated and distributed upon sale or refinancing. A clear exit strategy is crucial, detailing when and how the property will be sold or refinanced, and how profits will be divided. These agreements are often used to help family members or close associates acquire a home, but they can also be structured between unrelated parties. Legal counsel is essential to draft a comprehensive agreement that protects the interests of all co-owners and addresses potential contingencies. It ensures fairness and transparency throughout the co-ownership period. Wholesaling real estate fundamentals. Wholesaling real estate is a short-term investment strategy where an investor, known as a wholesaler, acts as an intermediary to facilitate the sale of a property between a motivated seller and a cash buyer. The wholesaler identifies distressed properties or motivated sellers, puts the property under contract, and then quickly assigns that contract to an end buyer for a fee. The wholesaler never actually takes ownership of the property, minimizing their risk and capital outlay. This strategy is ideal for individuals who want to enter real estate investing with limited funds and focus on marketing and negotiation skills. It's a fast-paced business model that relies on finding undervalued properties and a robust network of buyers. The process typically involves finding a property at a significantly discounted price, often through direct marketing to sellers or by identifying properties in pre-foreclosure. Once a purchase agreement is signed with the seller, the wholesaler then markets the contract to their network of cash buyers, usually other investors looking for properties to fix and flip or hold as rentals. The difference between the original contract price and the price the end buyer pays for the assignment is the wholesaler's profit. Speed is crucial in wholesaling to ensure the contract doesn't expire and to maintain the seller's motivation. Building strong relationships with both sellers and buyers is key to consistent success in this highly transactional niche. Assignment of contract in wholesaling. The assignment of contract is the core mechanism of real estate wholesaling, allowing the wholesaler to profit without ever taking ownership of the property. When a wholesaler finds a motivated seller and puts a property under contract, they are essentially acquiring the right to purchase that property. Instead of closing on the property themselves, they sell this contractual right to a third-party cash buyer. The assignment agreement formally transfers the wholesaler's rights and obligations under the original purchase contract to the new buyer. This process is legally straightforward, but requires careful attention to the terms of the initial contract to ensure it is assignable. Many standard real estate contracts include clauses that permit or restrict assignment, so reviewing these is crucial. For the assignment to be successful, the original purchase agreement must explicitly allow for assignment, or be silent on the matter, implying assignability. If the contract prohibits assignment, the wholesaler may need to negotiate an amendment with the seller or consider a double close strategy, which involves two separate transactions. The assignment fee, which is the wholesaler's profit, is typically paid by the end buyer at the closing of the property sale. It is vital for the wholesaler to clearly communicate the assignment process to both the seller and the end buyer to maintain transparency and trust. A well-executed assignment of contract facilitates a quick, efficient, and low-capital transaction for the wholesaler, making it a powerful tool in creative financing. Contract for deed/land contract. A contract for deed, also known as a land contract or installment land contract, is a creative financing arrangement where the seller retains legal title to the property while the buyer takes possession and makes installment payments. Unlike a traditional mortgage, the buyer does not receive the deed until the full purchase price, including interest, has been paid off. This method is often used for buyers who may not qualify for traditional bank financing or for properties that are difficult to finance conventionally. It provides a pathway to homeownership with potentially more flexible terms than a bank loan, as the seller and buyer directly negotiate the agreement. It allows the buyer to build equity over time. For sellers, a contract for deed can provide a steady income stream and potentially a higher overall return due to the interest earned. It also offers a quicker sale process compared to waiting for a buyer to secure traditional financing. However, sellers retain legal title, which means they are still responsible for property taxes and insurance, although these costs are typically reimbursed by the buyer. For buyers, the main risk is that they do not hold legal title until the final payment, meaning they lack the full protection of traditional ownership. If the buyer defaults, the seller can often reclaim the property more easily than through a traditional foreclosure process. Clear, legally sound contracts are essential to protect both parties' interests and define responsibilities. Due diligence in creative deals. Thorough due diligence is paramount in creative financing transactions, perhaps even more so than in traditional deals, given their non-standard nature. Buyers must meticulously investigate the property's physical condition, market value, and any potential liens or encumbrances. This includes professional inspections, appraisals, and title searches to uncover any hidden issues that could impact the investment. For seller finance deals, understanding the seller's motivation and financial stability is also critical. Neglecting due diligence can lead to unforeseen liabilities, costly repairs, or legal disputes, undermining the profitability of the entire venture. It is the buyer's responsibility to verify all aspects of the property and the deal structure. Beyond the property itself, due diligence in creative financing extends to scrutinizing the terms of the financing agreement. Buyers must fully understand all clauses, payment schedules, interest rates, and potential penalties for default. For subject to or wraparound deals, a detailed review of the underlying mortgage is essential to identify due on sale clauses or other restrictions. Sellers, in turn, must perform due diligence on the buyer's ability to make payments and their overall reliability, especially when extending credit. Engaging legal and financial professionals to review all documents and advise on potential risks is not merely recommended, but often a necessity. This comprehensive approach ensures all parties enter the agreement fully informed and protected. Legal and ethical considerations. Creative financing, while offering immense flexibility, operates within a complex legal landscape that demands careful adherence to regulations and ethical practices. Understanding state and federal laws governing real estate transactions, lending, and consumer protection is paramount. For instance, some states have specific disclosure requirements for seller finance deals, and certain creative strategies might trigger due on sale clauses in existing mortgages. Non-compliance can lead to severe penalties, including fines, voided contracts, or even legal action. It is crucial to ensure all agreements are legally sound, enforceable, and transparent, protecting all parties involved. Ignorance of the law is not an excuse, making professional legal advice indispensable. Ethical considerations are equally important in creative financing. Transparency and full disclosure are fundamental to building trust and avoiding disputes. All parties should be fully informed of the terms, risks, and benefits of the agreement, without any hidden clauses or misleading information. Avoiding predatory practices, such as exploiting vulnerable sellers or buyers, is a moral and legal imperative. Engaging licensed professionals, such as real estate attorneys and reputable escrow agents, helps ensure that transactions are conducted fairly and ethically. Upholding high ethical standards not only protects individuals, but also contributes to the integrity and reputation of the real estate investment community. Long-term success in creative financing is built on a foundation of trust and integrity. Negotiation strategies for creative deals. Effective negotiation is the cornerstone of successful creative financing, as these deals often involve more customized terms and direct interaction between parties. Understanding the motivations and pain points of both the buyer and seller is crucial for crafting win-win solutions. Active listening, empathy, and clear communication are vital skills. Instead of focusing solely on price, consider what other factors are important to each party, such as speed of sale, payment flexibility, or property condition. A seller might prioritize a quick close over a slightly higher price, while a buyer might value a lower down payment over a reduced interest rate. Identifying these underlying needs allows for more creative and mutually beneficial deal structuring. Preparation is key to strong negotiation. Before entering discussions, thoroughly research market comparables, understand the property's true value, and have a clear idea of your own financial limits and desired outcomes. Be prepared to present multiple options and demonstrate how your proposed creative solution addresses the other party's specific needs. Maintain a professional and respectful demeanor throughout the process, even when faced with resistance. Flexibility and a willingness to compromise on non-essential terms can often lead to breakthroughs. The goal is to build rapport and find common ground, ultimately leading to a signed agreement that satisfies both sides. Mastering negotiation transforms challenges into opportunities. Building your creative financing network. Building a robust network of contacts is arguably one of the most critical aspects of succeeding in creative real estate financing. Your network should include a diverse range of professionals, real estate attorneys specializing in creative deals, experienced title companies, private money lenders, hard money lenders, real estate agents open to unconventional transactions, and other investors. These connections provide invaluable resources, from legal guidance and funding sources to deal flow and mentorship. Actively participating in local real estate investment associations, REIAs, attending industry conferences, and joining online forums are excellent ways to expand your network. Remember, real estate is a relationship business, and creative financing thrives on trust and collaboration. Beyond professionals, cultivating relationships with motivated sellers and cash buyers is paramount for strategies like wholesaling and seller financing. Establishing a reputation as a fair, transparent, and problem-solving investor will attract more opportunities. Regularly communicate with your network, share insights, and offer value where you can. Mentorship relationships, both as a mentor and a mentee, can accelerate your learning curve and open doors to advanced strategies. A strong network not only provides access to deals and capital, but also offers support and guidance through the complexities of creative financing. It is an ongoing process of nurturing connections and building trust within the real estate community.